Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing PayPal stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 68 billion market cap. They're trading at $66 a share and they have 1 billion shares outstanding. PayPal connects merchants with consumers in order to send and receive payments online. It's just a safer way to buy things. Instead of giving every merchant your credit card, just store it in PayPal and use PayPal to buy things. You can also transfer and withdraw funds using various funding sources such as bank accounts or Venmo. You can also buy and sell cryptocurrencies. I bought $100 of Bitcoin on Venmo. That's currently worth $225 today. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They always have pretty solid and consistent free cash flow. $5 billion in 2021, $6.7 billion in the trailing 12 months. Pretty good margins. They convert 22% of their revenue into free cash flow. Their free cash flow grew 59% when you compare 2023 to the trailing 12 months. The trailing 12 months is from 7/1/2023 through 6/30/2024. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also really consistent as well, around $4 billion a year. It was low in 2022, but it rebounded nicely, up 76% into 2023, up another 5% into the trailing 12 months. Revenue is a sales for the company. Most of their revenue is transaction fees. That peaks in the trailing 12 months at $31 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $93 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $85 billion. We divide that by 1 billion shares. And we get a calculated stock price of $82. They're trading at $66, so they're trading at a 20% discount. It's a buy according to the model. And look at their free cash flow estimates. The next 3 years are all lower than the trailing 12 months. Let's say I grew their free cash flow 10% a year. Let's see what it would look like. If I grew their free cash flow 10%, which is not that aggressive of growth, it's doable, then the stock is $115 a share. So it looks like it's undervalued in most scenarios. There are 52 companies in the same industry as PayPal, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $600 million in CapEx, a lot more than the median average. Amex spends a lot at $1.8 billion. A good debt to equity ratio, 0.5, a lot better than the median average. A lot better than MasterCard and Amex, same as Visa. They do not pay a dividend. Most companies in this industry do pay a dividend. Look at OneMain, 7.5%. They pay the highest dividend. Their free cash flow is good, but a lot lower than the top 3 and number 5. They rank 4th in market cap at $68 billion. I know Visa, MasterCard, and Amex are different companies, but they are in the same industry as PayPal. The industry is credit services. It is hard to compare companies, even companies that appear to be the same. Like you would think Amex and MasterCard are very similar, but if you look beneath the hood, they're very, very different. Every company is very, very different. Excluding commodity type companies like gold miners, those are pretty similar. All their price multiples are worse than the median, but their price to book is better than the average, and their price of sales is better than the average. They generate $31 billion of revenue, which is more than MasterCard. And MasterCard is about 6 times their market cap. Really close to 6 times, because if you round up to 70 billion, 70 times 6 is 420, and they're 420. PayPal is still growing. Their 5-year annual revenue growth rate is 14%, double the median average. Blue Owl is growing at 28%. They're growing the most. If you put $10,000 into this company 10 years ago, you'd be at $17,000 today, which seems like a good return, but you'd be pissed because at one point in 2021, your $10,000 investment was close to $70,000. It's come down a lot since the peak. They just released earnings a couple of days ago. Let's go through their 10Q. Here's their income statement. The second quarter of 24, second quarter of 23, first half of 24, first half of 23. Let's just focus on the quarterly numbers. Revenue 7.9 billion. It was 7.3 billion. So that's a nice jump. Let's get a breakdown of the revenue. The great thing about PayPal is they can easily scale all around the world. Of the 7.9 billion of revenue, 4.6 billion is in the US, 3.3 billion is in other countries. They do footnote other countries. No single country is more than 10% of total revenue, so they're highly diversified. Here's a different breakdown of the revenue. 7.2 billion of transaction revenue. When somebody buys something on PayPal, the person that sold the merchandise pays a fee, 1%, 2%, 3%. I think the fee may go down if you do a lot of transactions, like you're a really big company. I know credit card fees are generally between 1% and 3%, depending on the card, depending on the volume, etc. They do generate 700 million of revenue from other value-added services. I know they provide loans. They mention it down here. Some revenue is interest and fees earned on loans and interest receivable. They also have hedging gains or losses and interest earned on certain assets underlying customer balances. I like reading the notes in the financials. You get a little more color on things. They also give some basic info, which is good to know. We enable customers to send and receive payments. We earn revenue mainly by completing payment transactions for our customers on our payments platform and from other value-added services. Let's go back to the income statement. Some people ask me, how do I know all this stuff? Like, for example, how do I open a 10K or 10Q and just tear apart the info explaining everything? I pretty much just kept searching terms. Like, I would search most terms. Even though I understand what sales and marketing is, I would just search that because every company has a different description. Or I would search these dollar amounts and read up on them. Some things I didn't really understand. Then after the fifth or sixth time reading about it, it starts to make sense. It's hard to understand things unless there's a purpose. Like if you just read what is derivative, you probably won't absorb it. But if you read a 10Q and they explain how they had a gain or loss from a derivative, it might make a little more sense. Maybe not the first time, but the 10th time, it's gonna make sense. Especially if you connect it with something else. Like there's a news report that PayPal had a big loss from hedges on interest rates. And then when you read the 10Q and you search that, things start to come together. I don't know if I explained that so well, but if you watch my videos, you probably understand what I mean. Let's see what expenses they have. Their biggest expense is transaction expenses, almost 4 billion, which is about 50% of their revenue. Let's search transaction expense. Actually, before we search it, let me make one point. So their revenue, the 8 billion, that's not the volume of transactions, that's just their fee. Like I mentioned earlier, their fee is probably around 2%, maybe up to 3%. A big part of the transaction expense is payroll, but let's see if we get a little more color on it. Here's a 3.9 billion of transaction expenses. Their transaction expense rate is almost 1%. So if they charge 2% to move funds, about half of that are expenses. The other half is profit. And the way you calculate this 0.95%, you can see the footnote right here, number 1. Transaction expense rate is calculated by dividing transaction expense by TPV. If you're not sure what TPV is, we can just search for that. It's right here, total payment volume, TPV. You could even Google the term, it's a pretty common term, but some acronyms may be hard to find on Google. This page gives us a lot of info. TPV, number of payment transactions, active accounts, and number of payment transactions per active account are key non-financial performance metrics that management uses to measure the scale of our platform and the relevance of our products and services to our customers. So TPV is the value of payments, net of payment reversals. So if somebody has to refund a customer, that's taken into account. So if I buy something for $500 and I pay $15 in fees to PayPal, TPV is $500. Number of payment transactions is a total number of payments net of reversals. Here they define what an active account is. You'd be surprised how different an active account is with different companies. Some companies keep accounts active forever. Other companies only have active accounts if you used it within the past month, others within the past 12 months. So you would have need to complete a transaction within the next 12 months to be considered active on PayPal. Let's go back to their operating expenses. So transaction expense is up 11% from last year. which is similar to how much their revenue grew from last year. Credit losses are down 16% because they provide loans to small and medium-sized businesses. Customer support and operations, that's also down 11%. That's really good. A bunch of their expenses are down even though revenue is up. Transaction expense pretty much has to go up because it moves with revenue. Unless revenue goes down, then transaction expense will go down. Marketing is down 4%, technology and development is down 3%, general and administrative is up 16%. Restructuring went from 24 million to 113 million. Restructuring are one-time costs companies make when reorganizing their operation. For example, if a manufacturing company closed one of its facilities, or another example, say PayPal furloughed 1,000 employees. This section talks about restructuring. It's up from 24 million to 113 million. For the trailing 6 months, it went from 188 million to 325 million. And they explain what the restructuring is. They initiated a workforce reduction intended to streamline operations, focus resources on core strategic priorities, and improve our cost structure. So when they lay off a lot of employees, that could lead to a lot of big one-time expenses like severance, stock-based compensation, because those expenses have been accrued by the employees, so they have to pay them. If somebody quits, they may not have to pay those, but when they lay people off, they usually have to pay it. And they had a big reduction in employee-related costs of 565 million, including 150 million of SBC. We expect to reinvest a portion of that money. So their total expenses for the quarter, 6.6 billion, operating income 1.3 billion. I like looking at percentages. Revenue is up 8%, operating expenses up 7%. So their operating income went up 17%. Because when expenses increase at a lower rate than revenue, your margins increase a lot. As you can see here, only a 1% difference resulted in a 17% jump in operating income. Their operating margin is 17%. That's just a coincidence, because you can see here in a trailing 6 months, operating income grew 17%, but their operating margin is 16%. Operating margin is operating income over net revenue. It's a percent of your revenue you convert to operating income. 270 million of taxes. Their effective tax rate is 19%. Effective tax rate is income tax expense over operating income. It's the percent of your operating income you pay in taxes. So their net income 1.1 billion, up 10%. EPS 108, up 17%. On the income statement, they show the shares outstanding. They're buying back a lot of stock. It was 1.1 billion last year. Now it's 1.04 billion. Let's dive into the balance sheet. After the income statement, the balance sheet is the most popular financial statement. It shows you the value of the company, the accounting value, and the value is assets minus liabilities. Assets are what the company owns. Current assets are assets that can be liquidated into cash within 12 months. And it starts with the most liquid to the least liquid. The most liquid is cash, 7.7 billion. I don't see a breakdown, but they usually give a breakdown. Like it could be in CDs or money market funds. Here's a footnote number 1. This includes 85 million and 777 million of available for sale debt securities. Below cash or short-term investments, 5.9 billion. Of the 5.9 billion, 236 million are time deposits, like CDs. 5.7 billion of available for sale debt securities. They give a breakdown of the 5.7 billion. Available for sale debt securities are purchased with the intent of selling them before maturity. Other assets are considered held to maturity assets or held for trading. Available for sale are highly liquid, so they need the funds at any point. So that's why they don't hold them till maturity. 85 million are U.S. government and agency securities, 884 million more U.S. government and agency securities. Foreign securities, 170 million. Corporate debt, 1.3 billion. Mortgage-backed securities, 650 million. Commercial paper, 2.6 billion. I love Investopedia. It gets straight to the point. I learned a lot from this website. Commercial paper is unsecured short-term debt. Lots of big companies issue commercial paper to fund payroll, inventory, etc. The maturity date on a commercial paper could be as low as 1 day up to 270 days. If you buy commercial paper, if you invest in commercial paper, you don't receive any interest, but you buy it at a discount. Let's say you wanted to buy $10,000 of commercial paper that matured in 30 days. You wouldn't pay $10,000, you would pay $9,950, for example. So you don't get paid interest, but you buy it for less than what you get at maturity. They have $63 billion of current assets. Their biggest current asset are funds receivables. And you'll see a similar amount in funds payable. These are the transactions between vendors and customers. It's just a timing thing. They take in the money, usually hold it for 1 or 2 days because they want to earn interest on that money, and then send the funds to the person selling the product. They also have $5.3 billion of loans. Let's see if they talk more about that. Here they talk more about the loans. They offer their UK customers PayPal credit, which is a funding source in their PayPal wallet once they're approved. Also at checkout for US customers and some countries in Europe, Australia, and Japan, they offer loans. They offer non-interest credit as well as interest-bearing credit. Say you wanted to buy something for $1,000. You'd have to pay 4 payments of $250 over the next 4 months. As long as you paid on time, it's probably no interest. But if you're late, then you would have to pay interest. They closely monitor the credit quality of these individuals so they're not exposed to too much risk. I just got notified on my phone Meta released their earnings, and it's up 8% after market. Nice. I own a lot of Meta, as you probably know. The quote by Mark Zuckerberg, "We had a strong second quarter, and Meta AI is on track to be the most used AI assistant in the world by end of year." Revenue $39 billion for the quarter, up 22% from last year. They're just a monster, this company. They report such good numbers. Expenses up only 7%. Operating income up 58%. Look at those margins, 38%, up from 29%. 3.3 billion people use Meta products daily, 7% increase. They pretty much have the perfect business model, highly scalable and high margins. Selling ad space on their platform. It's a great business model. Here's a breakdown of their receivables. 2.3 billion are current, 30 million are late 30 to 59 days, 18 million 60 to 89 days, 39 million 90 days plus. Charge-offs was 69 million. These are people who they just gave up on and they charge off the loan. They have 39 billion of funds receivables. This is just money they're holding for their customers, for their transactions. Then they have 4 billion of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future. They have a lot of goodwill, 11 billion of goodwill. Goodwill is a premium you pay when you acquire another company. Total assets 84 billion, up from 82 billion. Total liabilities 63 billion, up from 61 billion. Their biggest liability is funds payable. These are funds due to customers. That's the opposite side of the transaction for funds receivables. They have 10 billion of long-term debt. Assets minus liabilities equals equity, 21 billion of equity. They buy back a lot of stock, 24 billion. When you see treasury stock, that's a stock the company buys back. They buy the stock in the open market and put it on their balance sheet as treasury stock. Treasury stock is a contra equity account, so it brings down your equity balance. They received $20 billion from selling their business. Additional paid-in capital is how much money they raised from issuing stock. They profited $25 billion from running their business. Retained earnings is sum of all their prior net incomes. Let's look at a statement of cash flows. This is for the trailing 6 months. Operating cash flow looks great. It went from 1 billion to 3.4 billion. A really big improvement. The way you calculate operating cash flow, you start with your net income, then you add or subtract the non-cash items on the income statement. You have to adjust for changes in working capital. Things are looking up for this company. They spent 311 million of PP&E. I just noticed this page on crypto. This table shows the crypto assets they hold for the benefit of their customers. So it's not their crypto, it's their customers. Same thing if you put money to a bank account. That money is not Wells Fargo's money, it's your money. They're just holding it for you. They're holding 1.5 billion of Bitcoin, 870 million of Ethereum, and 100 million of other crypto assets. That's double last year, almost exactly double. It doesn't really matter to PayPal if the value of these crypto assets goes up or down. But I guess if it goes up a lot, they may be able to stake the crypto and make more money on staking it. We allow our customers to buy, hold, sell, convert, receive, and send certain cryptocurrencies. And they could use that crypto to purchase items at checkout. These cryptocurrencies consist of Bitcoin, Ethereum, Bitcoin Cash, Litecoin, and PayPal USD stablecoin. It doesn't look like PayPal holds the crypto. They have third-party custodians that hold the crypto for the benefit of PayPal's customers. And they have 2 third-party custodians to hold the crypto. The reason this page popped up is because I searched 1459. You can see that's the value of the Bitcoin they hold for their customers. It just happens to be the same as their PP&E. Their property and equipment happens to be 1459. It's just a coincidence. Bitcoin is definitely not PP&E. When customers take loans or pay back loans, that's also in the investing section. They loaned out $10 billion. They received $9.8 billion of proceeds from those loans. Purchase of investments are just short-term investments, like bonds or commercial paper. They received $14 billion when they sold some of those investments. In their financing section, they issued $55 million of common stock. They bought back $3 billion of their own stock, same as last year. This is for the trailing 6 months. So in the first half of the year, they bought back $3 billion. They added $1.4 billion of debt under a financing agreement. They repaid $400 million of debt. So in their financing section, they had a cash outflow of $2.2 billion. The cash at the end of the accounting period is $19.4 billion. And if you look at the balance sheet, cash is only $7.7 billion. Why not 19.4? They give a breakdown of the 19.4 billion. That's a sum of 7.7 billion plus 3 million of short-term investments plus 11.7 billion of funds receivable. So you can see the 11,654 in a balance sheet. Part of this 38.7 billion. Here's a breakdown of the 38.7 billion. 11,654 of cash and cash equivalents. If you're confused at all, don't worry about it. It took me a long time to figure this out. It's hard to explain so much on a video. This is a good thing to talk about on the live stream because we can go back and forth. Let's go through their second quarter presentation slides. Look how big their transaction volume is, $1.6 trillion. That's the amount of money they're moving. That's a lot of money. And that's across 26 billion transactions. Tens of million merchant accounts, 400 million consumer accounts, and more than 2,400 strategic commerce partners. These are the companies that help them move money. They say the e-commerce market is $6 trillion, so they have a pretty big chunk of it. That must just be in the US, because Alibaba alone moves more than $6 trillion. I think it's like 11, 12 trillion. You can see here China is half the e-commerce market, US 20%. And the next biggest is UK, 3.4%, then Japan, South Korea, Germany, France, and all of the countries, 10%. Total payment volume in the second quarter, $417 billion. That's how much money they moved, all the transactions. Their revenue, the fee, almost $8 billion. Transaction margin, their profit after expenses, $3.6 billion. Free cash flow, $1.4 billion. They have 429 million active accounts. Monthly active users, 222 million. So 200 million of these active accounts use the service less than once a month. So they may use it every quarter or every year, but 222 million people use it at least once a month, which is a 3% growth from last year. 6.6 billion transactions, up 8%. Their average customer makes 61 transactions a year. I know I'm well above that. I probably use a couple hundred. That's up 11%. Only 2% of their transactions are from eBay, 18% from Venmo. But a lot of merchants use PayPal. Let's say you wanted to buy furniture and the store offers PayPal. That's part of that 28%. Revenue for the second quarter, $7.9 billion, up 8%. Their profit, $3.6 billion. Non-transaction expenses, $2.1 billion. So operating income, $1.5 billion, up 24%. They expect the third quarter revenue to grow at mid-single digits. So maybe 4, 5, 6%. GAAP EPS for the next quarter, 96 and 98 cents. And here's their 2024 projections. $6 billion of free cash flow. And it looks like that's up. Previously it was $5 billion. And they expect to use all that money for buybacks, $6 billion of share buybacks. They mentioned 2 of their big partners, Meta and DoorDash. You gotta love Meta, they're everywhere. They're seeing continued growth with debit cards. That's why they raised 2024 guidance with increased confidence in long-term profitable growth roadmap. which is why they increased their buybacks to 6 billion. Here's the last 12 quarters active accounts. Pretty much flat. It was highest in the fourth quarter of 2022, 435 million. That's not what you want to see. I'm surprised it went down. Monthly active users, that's at the peak, 222 million. So that's good. It looks like they got rid of some older stale accounts that weren't being used. 2 quarters ago, in the fourth quarter of 2023, had the highest number of transactions, 6.8 billion. Now it's 6.6 billion. Transactions per account is at the highest ever, about 61. Total payment volume, 350 billion, up to 417 billion, their highest ever. They hit their highest in the US. International was higher in the fourth quarter of 2023. Not much higher, a little higher. Venmo grows a lot each quarter, from 64 billion to 73 billion. The first time they were over 70 billion for a quarter for Venmo. The take rate is the fees they charge, 1.89%. It was almost 2% in the first quarter of 2023. I guess there's lots of competition, so maybe that's why they lowered their rate. Transaction expenses, 3.9 billion. It was higher 2 quarters ago, slightly higher. Transaction losses, sometimes you buy a product and the person you pay doesn't send you the product. That's happened to me before, so PayPal reimburses you. That's gone down. That's a number you want to see decrease. It's at its lowest point in the past 6 quarters. Credit losses on loans, 76 million. It was a little lower last quarter. Their margins are in the mid to high 40% range. EPS is $1.19. That's the highest in 6 quarters. Operating margin 18.5%. That's also the highest. And free cash flow, it was negative in the second quarter of 2023, 2.5 billion in the fourth quarter of 2023. But you want to compare it to the same quarter last year. It went from negative to positive 1.4 billion. And they always have positive free cash flow. Last year at this time, 869 million. Now it's 1.1 billion, up 31%. The free cash flow of 1.4 billion includes 200 million in the timing impact of their European buy now, pay later program. They bought back 1.5 billion of stock in the second quarter. They have 18.3 billion of cash, debt of 12.2 billion. Revenue grows each year, 2021, 25 billion, 2022, 27.5 billion, 2023, about 30 billion. And on a quarterly basis, it looks like they had their best quarter ever in the most recent quarter, 7.9 billion. Actually, no, it was a little over 8 billion in the fourth quarter of 2023. So it's a second best. Operating income was second best, 1.46 billion. 2 quarters ago it was about 1.47 billion. Free cash flow is down a little, was 5.1 billion in 2022, now it's 4.6 billion. This is for 2023. But so far for the first half of 2024, it's 3 billion. Almost exactly 3 billion. It's 2.996 billion. So 3 billion in 2 quarters. So they're on track for 6 billion. The stock will go up a lot if they hit 6 billion. Let's look at a stock on Simply Wall Street. Its last price, 62 billion market cap, up 7% in the past week, down 15% in the past year. Here's the stock price since they started trading in 2015. It started out in the mid 30s. And then for 2 years, it didn't do too much, up a little bit, maybe 10-15%. And right before COVID, it was 116. Then from the COVID crash, it came down to the mid 80s. If you got it then, you were a genius, assuming you're not still holding. Because if you exited north of 300, you would have hit a grand slam. Because the stock has really struggled since 2021. Because it went from 300 down to the 50s. It's been in the 50s or 60s for about a year now. So since mid-2022, the stock hasn't done too much. There was a peak at one point up to 100, but it came back down. It's kind of been trading sideways for a while. Simply Wall Street is bullish on this one. They're at $95 a share. They say they're 33% undervalued. 38 analysts priced this stock at 77. They also say it's undervalued. Their revenue forecast for this year is 32 billion. Next year, 35 billion. After that, 37 billion. Their free cash flow forecast for this year is 6.1 billion, then down to 5.9 billion, then up to 6.3 billion. They were debt-free in 2015, 16, and 17. Then they added some debt, and now their debt has ballooned to 11 billion. But it's not that bad when you look at their equity. Their equity is always higher than their debt. Equity of 20 billion, debt of 10 billion. and their cash is higher than their debt, so they're in pretty good shape. The CEO's salary is $300K, total compensation $43 million, tenure as CEO less than 1 year. He founded and sold 2 startups. He also led a division at Intuit. He was at Intuit for 20 years. Where did he find the time to find 2 companies and then sell them? In the past year, a couple of insider sells, no buys. 70% of the company is owned by institutions, 30% by the general public. Their biggest shareholder is Vanguard at 9%, then BlackRock, State Street. The Los Gatos financial firm, Comprehensive, owns 2.7%. Morgan Stanley, Citadel. Loomis Sayles, the Boston investment firm, owns 0.66%. Eaton Vance, Barclays. PayPal's employee count was 16,000 in 2014. It peaked at 31,000 in 2021, but they laid off some people down to 27,000 currently. And the ticker trades on the Nasdaq, Deutsche Börse, Xetra, Mexican Bolsa, London Stock Exchange, Swiss, EuroTLX, Wiener Börse, Lima Bolsa, Bulgaria, Kazakhstan, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and NEO. Let's read some employee reviews. This is from Glassdoor.com. It's good to get some insight into what employees think about the company, and then we'll read some customer reviews after that. Beyond terrible, be warned. It is a good name in theory, but an actual disaster in person, yikes. Would not recommend to anyone, particularly HR. Favoritism, toxic leaders who don't actually know how to lead and overlook efficiency and innovation in lieu of compliance. Cons, so many downsides on the people team. The processes are comically outdated and no interest in changing them. I think a lot of companies have outdated processes. The leadership has no idea what they're doing. It's compliance over anything. Another 1 out of 5. The pros, lots of great people are still working here for now until they can find something better or new leadership eliminates them as part of their business strategy. Strategy in quotes. They used to have great culture before new leadership wrecked this. Remote work flexibility and decent pay. Cons, new leadership is reckless, cruel, and incompetent. Constant layoffs. Hypocrisy, gaslighting, total lack of empathy, and continual poor business decisions. We've laid off many of our top performers to get lean. This is a current employee. They've been there less than a year though. New leadership seems to have no clue what they're doing and cares more about moving the stock price $1 to $2 short term than employee retention, engagement, or livelihood. This is bringing me down. Let's read some positive ones. A 4 out of 5. Amazing culture, decent pay and growth. The cons are corporate politics. Anonymous employee, best place to work at. The cons, nothing. 3 out of 5. Former employee. Pros, enough paid time off and can work from home. The cons, under pressure and pandemic, unemployment assistance. 2 out of 5. Dying culture, not the same company after previous CEO. The pros, sabbatical. Remote work, unlimited PTO. It's a good pro. The cons, leadership, constant layoffs, lack of vision, no emphasis on employee well-being like previous administration. Too many vice presidents. A lot of companies have too many vice presidents. 2 out of 5 in PayPal Tel Aviv. A current employee more than 5 years. I'm much more likely to listen to the review of an employee who's been there more than 5 years. Pros, so-called stability, but not really. Doesn't sound like a pro to me. The cons, layoffs every quarter, stock keeps falling, not enough innovation. In the past 5 years, the stock has fallen a lot. In the past year, it's been sideways. A 3 out of 5, pros, good culture, good leadership, good product. The cons, bad pay, high quotas. Here's the next review. Good work-life balance, good support from managers. As with any multinational company, you may not get very challenging work. Pros, if you survive the regular layoffs, there could be a chance for promotion. The cons, the leadership is constantly changing, but the difficult processes remain the same. Advice to management, spend more time understanding what and why your people work on before deciding on sweeping changes with layoffs, new leaders, and new systems. Amen to that. Pros, exposure to high scalable systems, flexible working, clear roadmap from leadership under new CEO. The cons, less pay and perks compared to other product companies. Employees at every company feel they're underpaid. Another con, recent layoffs impacted internal processes. Pros, easy work-life balance, unlimited PTO, not stressful sometimes. Not stressful sometimes. That's an eloquent sentence. I am happy unless I'm mad. Cons, leadership is disorganized and not transparent. So this person is transparent. They do not identify as a male or female. New CEO with aggressive deadline. Look at this title, hiring and firing at the same time. Work from home in some teams and tech stack. That's a pro. Con, constant restructuring happening internally as well as overall. They do a lot of restructuring with all the layoffs. Awesome company. There is a long list of pros. Great company, great work ethics, great perks. Great work-life balance. Everything is amazing here. Cons, increment is not there for max of employees. That's a weird sentence. Advice to management, please work on appraisal part. You are already doing good, but appraisal is something depends on which an employee look forward to their further journey with the company. That was a hard sentence to say. It took me about 5 takes to say it, because I try to read verbatim. 4 to 5, but look at the review. Pay bad, management bad. You would think it would be a lot lower. Pros, coworkers are nice and helpful. Cons, management has lots of bullying problems. You don't want bullies at management. Pros, new technology and domain experience. Cons, no work-life balance in working. Sounds a bit redundant. Proceed with caution. Coworkers, benefits, PTO, vacation, culture, inclusive. Cons, greedy, leadership, favoritism, heavy metric focus. Pros, pays the bills, lots of change. Cons, slow, fast. That's interesting. They're slow and they're fast. Complicated, messy since new Echo. Oh, the new eco-friendly CEO. He cares about the environment. A summer intern, very, very nice recruitment team. Cons, nothing is bad here, to be honest. TBH. Pros, unlimited PTO. Peers are great to work with and want to do the right thing. Cons, new leadership making uncertain decisions. Pros, decent benefits, product works, remote work. Cons, lack of alignment, old product, bureaucracy. The pro was product works, the con was old product. Oh, I guess it just works. It doesn't work well, it just works. Pros, lots, if benefits. Good work-life balance, a place to grow. Grow what? Grow weed? What the hell do they grow there? Cons, I have been working there 2 years and I don't see cons. Give it time, buddy. Give it time. Pros, used to have a lot of good things to say prior to March 2024. Now it's just good compensation and the option to apply to go to remote if you live in another city. Cons, after the layoffs, we've seen a huge increase in workload. Working long hours every single day. If I take a day off, I have to work double, as there is no backup to rely on. To top that off, contact gaslighting by management saying, this is a one-person job. The amount of detail we are expected to go into clearly requires 2 people for a project, if not more. Advice to management, hire, hire, hire. Do not leave critical projects and tasks solely up to a single person. Stop the constant gaslighting and listen to what the employees need in order to be able to work efficiently while maintaining their health, well-being, and sanity. Pros, met some cool people, but that's about it. Cons, leadership was a huge mess. They were never on the same page regarding issues. What is he reading, a book? What page are you talking about? And they all provided different information when you asked for help. That's like that anywhere. Everybody has their own opinion. There was also a lot of false hope. Going in, you are promised longevity and growth with the company, and then all of a sudden you are being laid off because they are moving every single job overseas. They even misled me about the job I was hired on for. They promised that I was going to be a sole chat agent during the interview, and when I got hired on, we were immediately thrown into the phone queue. Overall, just a terrible experience. They also kept changing our benefits every year. Just absolutely zero consistency across the company. Work-life balance is outstanding. People working there can make their own time for family. Cons, and those big functions, promotions sometimes seem like difficult. It didn't seem difficult, it seemed like difficult. Pros, good medical benefits, good leave policy, nice working environment, shift rotation, and at times you can feel that there is just one-way communication from higher to junior level. Another transparent. Lots of trans in this community. Make things transparent with employees. Do regular skip levels so employees won't be hesitant. Take feedbacks and improvements regularly regarding the products to enhance the services. Pros: consistent schedule, great health benefits. Cons: weak management, weak communications of expectations. Pros: work-life balance and remote working environment. Cons: the salary is a bit low. Pros: wide variety of projects, types of clientele, and evolving product. Cons: massive change, unclear comp changing in year with new leadership. Pros: good leave policy that allows for adequate time off and personal days. Supportive colleagues who foster collaborative work environment. Cons: not a competitive salary compared to industry standards. Limited opportunities for career growth and advancement. Mentally stressful with high pressure situations and unachievable targets. Lack of job security with frequent changes in staff and management. Pros: benefits, some coworkers, set schedule. The cons: not LGBT friendly, but they are LGBTQ friendly, just not LGBT friendly. Manager changes every couple of months, no opportunity for growth in some departments. Pros: the projects are meaty with a lot of ownership. Cons: the culture is degrading over time. Lots of new VPs, new CEO, and lack of company direction. Advice to management: create culture, have better benefits, and allow for flexible working. Let's read some of the comments on Yahoo Finance. So we're going to see a lot of comments the past 24 hours since they just released earnings. The analyst increased the price target to 70 to 75. If the stock gets to that price, they will rise again, and so on. If the stock goes down, they will go down immediately. It is a jock, this people. Look at Nvidia, very overvaluated, but they keep giving high price targets, even if the stock doesn't deserves it financially. Analyst only goes where the flow goes. That is true, because they want to be right. So you just continue giving a higher price target, so you can say you are correct. Time to sell, 10%, okay. Never will reach much more than 67 in this year. We are going down, down, down. Someone gave it a thumbs up, and I'm gonna give the fourth thumbs down. New business model needed. Focus on Venmo as anchor of company. Definitely focus on Venmo. Going down to Chinatown. Looks like 67 is going to be way more difficult to break than I thought. Get ready for the dump. 9 thumbs down, make that 10. Have to admire your tenacity, up 12% in 2 days and multiple upgrades, but you stay firm in your multiple postings about a collapse. Nah, earnings are up, the math doesn't care, it's going up. New deal is keep buying shares back. I like that. Earning is growing about 10% and total shares are being reduced 10%. It means PayPal will beat the company every quarter and stock price will eventually react to the earnings surprises. Good luck to all. Perfectly said. Nobody cares. Wall Street wants innovation. Either innovate or die. Obsolete payment systems being left in the dirt. This will be 50s again in a few days. It's just like Kamala trash. Cry. How did PayPal get a float of 1 billion shares with no splits that I can see? 1.5 billion share buyback will not do much for reducing share count. Better than nothing, that's actually 2% of the business, 24 million shares. Nice volume again, hoping for a real breakout. Earnings are great. What will keep momentum going past 70-80? Maybe layoffs, upgrades. Needs a few more upgrades and a rate cut. You could bash the comments section if you want, but I do learn some things. Sometimes you get some nuggets here and there, I'm being serious. Because you can't know everything about every company, so sometimes reading the comments gives you some information that you normally wouldn't read. Going to make a run at 67 again later today, fingers crossed. Sold today, will buy back when it crashes again. Let's make PayPal great again. I like that one. Barely up while the rest of the market is ripping. Worst stock I've ever owned. Just cover your puts, man. 67 resistance is hard to cross. Failed again today. We'll see if there is a sustained push again to hopefully cross it. But if an earnings release like this can't do it, not sure what will. Bye, over 100. Took profits, thank you pulp. Last push for today. Not selling single share until 80s. Until the 2080s? That's over 50 years away, buddy. Why the 80s? This is still a growing company with new leadership making big moves. I'll reevaluate my position when it hits a 40 PE. The PE is 16 according to Yahoo Finance. Let's go 65. That wall at 67 was hysterical. Amazing how the big boys can't stop a stock dead in its tracks and reverse course to the penny. If that's not corrupt, I do not know what is. You were the noob saying this is heading towards low 50s. We will be above 70 by end of week. Such a great call from Alex. Congrats to the holders. Crash. I don't play resistance. 67. Bulls are booking the profits. Soon under 66. Elon will keep it going up. This is his baby. Elon doesn't give two F's about PayPal. What? Took them profits. Too soon, but too much money on the table. How much profit? 10% is not even worth getting into a stock. Do that twice a year on your portfolio, year in, year out. You're outperforming 99% of all professional managers. He got him there. He got him there. Hey guys, it might be better to sell and buy some Hood instead of PayPal. Hood is more profitable and start its own credit card program. Laugh aloud. What? Hood is more profitable? And the new gold credit card has positive margins. You sure? It's about time this sloth made it across the road. Ha 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 ha! Square, good results. Would surely help in breaking the resistance levels. 95 end of year. I agree. Bye-bye 60s. 1 minute and 40 cents down. Do not think it'll hold 66. What? It's bear hunting season. Did you buy your license via PayPal? Nice volume. Finally, after 2 years holding this sleeping giant. We will close above 67 this week. Go PayPal. We all need to go out and buy things using PayPal. Let's keep this rally going. Finally, someone with a good comment. Will said, huge resistance. Pay stonk. Great walls to climb. 68, 71, and 74. Good luck. Going to be almost impossible to break through the top end. Just look at the options. I have never seen more annoying person. Time to close up shop for a while. PayPal. Susquehanna raises target to 83 from 71. It's a big raise. Fly high, my love. I've been waiting so long for you. Bernstein upgrades PayPal. I have seen at least 10 price target upgrades. Nice, thanks. 66 plus today. Let's get another $2 plus today. Let's go PayPal. Where are my upgrades at? Bernstein upgrade. Man, so many new faces here after the earnings report. I just hope Wizard is okay. He is back in his hot air balloon going to Kansas. Hee hee. He'll survive waiting for this moment to strike. I'm averaging up. PayPal is a cheap and huge turnaround play, in my opinion. I'm glad he's validating that, saying in my opinion. If he didn't say that, I would think it could be somebody else's opinion. Couple more similar ERs and we'll be flying. 67 will be like a wall of bricks. Sorry guys, I should have showered. What the hell does that mean? 66 plus by the end of the week. 72 next week and 52 week high. A giant is waking up. 120 this year, I don't see why not. Not a chance, but I'd be very happy if it did. Crash for tomorrow. People take profit. We are stronger today than we were 6 months ago. And we will be stronger 6 months from now than we are today. We are executing against our game plan. This will be a long game. 6 months in, we are on the right trajectory. Shorts now. Ha ha. 58 was such an easy buy before earnings. LOL. Let's look at the top comments. There is a learning lessons for every investor. When this was at 310 back in 2021, a lot of analysts were saying this would be the next T. AT&T. Stock is going to 1,000. I think most analysts have no clue what they are predicting. Of course they don't. If they did, they would be the ones who are billionaires. And they would not have to work a clerk job and write articles. Ha ha ha. Investors taking advice from analysts is like a diver taking swimming advice from a stone. That's not funny. Just something to consider. There is a narrative that PayPal has been facing too much competition and is losing business. The answer is reflected not in profits but in revenue. Revenue is the metric that shows if a company is losing business or gaining business. This is why revenue is such a closely watched metric. Tell us more, Dr. Science. Here is something for serious investors. PayPal had great earnings, increased guidance, and yet some people want to only talk about margin pressure while ignoring the positive. How can a company be doing so well and at the same time some want you to believe they are falling apart? Look into the business segments of PayPal and what each is doing. Some parts of PayPal are in higher growth phases and have less margins, while others have matured and have higher margins. Trying to equate margin pressure on some of the company to the whole company is disingenuous. This is why when you look at PayPal in totality, the slight margin decrease does not sync up with the improved earnings and guidance overall. Have a great weekend. They are not falling apart, they're just struggling to find future revenue in a highly competitive business. A new PayPal value is currently being established by supply and demand. This could be a good trade, but not so much for a long-term investment. I think it is for a long-term investment, not a short-term investment. Oh, unless he's saying in the long term, they'll be out of business. So you can only make your money in the short term. So the market makers use high-frequency trading to rig PayPal's price at 78. PayPal grew 0% and had zero earnings and had the same book value since 2018. Really? Fair value right now is 135. If anyone listened carefully to the CEO's interview on CNBC, you will know the strategy moving forward is based on the enormous database PayPal has on over 35 million merchants and the 25% of global commerce they process annually. This will be used to improve conversion rates for merchants, improve their bottom line, target consumers, and utilizing AI to help target advertising, and thus increase revenue for PayPal. If PayPal is successful in what I believe to be AI-assisted target advertising, this will be huge and have a similar effect as it did with Meta. It has nothing to do with Bitcoin, which was never mentioned in the interview. Unfortunately, people had some pretty high expectations for a payment processing company when the CEO says, "Shock the world." If you watch the video to its entirety, they are really starting to adapt to ways to capture more clients, keep it current, clients happy, and to focus on revenue. No idea why people are crying here about it. You previously had a CEO that didn't want to adapt to anything and was very closed-minded. Now you have a young, ambitious CEO that's ready to move PayPal into the future. The foundation is there. PayPal is a very solid company. Competition should not scare folks here. Mobile payment market is in early days, and Venmo, PayPal in strong position. The TAM will expand tenfold in 5 years. Competitors will bring competition, of course, but they will also bring awareness and new users for PayPal. Plus, people use multiple services. Bye. I typed this almost 3 months ago at 63. Same holds true now after the latest ER. Bye. PayPal, like Bitcoin over the last 24 months, PayPal is clean, well thought out business with good transparency. CEO has finally been named. That is one major piece of uncertainty removed from the table. Stablecoins, leadership changes, share buybacks. This is all good long term. PayPal had a PE in the 80s a year or two ago. Now the PE is 11 with a growth rate in the 20% range. How is this trading at half its growth rate? Because investors are expecting the growth rate to slow more than what it's stated. Along with margin compression, the only thing that will save PayPal is another pandemic. You got that right. High frequency traders. Again, because the market does not trust the company. Potentially one of the most depressed stocks available right now. PayPal dominates, and by far, the field of digital payments. Behind the scene, using a competing platform most likely relies on PayPal's various assets. This is a 4x return in a 4 to 5 year period. Okay, I'm getting pretty tired now. Thanks for watching the video. Comment, subscribe, talk to you soon.